Every month, millions of traders around the world wait for a single number. And when that number is released, currencies can move hundreds of pips in minutes. Traders panic, charts explode, and entire strategies change instantly. That number? Inflation. If you're trading Forex and you don't understand inflation, you're basically trading blind. Let's start with the basics. Inflation simply means prices going up over time. If a burger cost $5 last year and now costs $6, that's inflation. In simple terms, inflation shows how the cost of living changes in an economy. And one of the most common ways economists measure it is through something called the Consumer Price Index, or CPI. This index tracks the average price of everyday items like food, transportation, housing, and clothing. When those prices rise, inflation goes up. But why does this matter for Forex traders? Because inflation has a huge influence on central banks. Central banks like the Federal Reserve or the European Central Bank constantly monitor inflation levels before making major decisions. And the biggest tool they use to control inflation is interest rates. Here's how the chain reaction works. If inflation becomes too high, central banks may raise interest rates. Higher interest rates make borrowing more expensive. People spend less money, and inflation slowly cools down. But something else happens too. Higher interest rates often make that country's currency more attractive to investors, which means the currency may strengthen. Now imagine the opposite situation. If inflation drops too low, it could signal that the economy is slowing down. So central banks may cut interest rates to encourage spending and investment. Lower rates make borrowing cheaper. People spend more, businesses invest more. But lower interest rates can also cause the currency to weaken. This is why CPI data is so powerful in Forex, because when new inflation numbers are released, traders immediately start asking one question: what will the central bank do next? Raise interest rates, cut them, or keep them the same? And since interest rates affect currency value, the Forex market reacts almost instantly. Professional traders understand this relationship. They don't just watch price charts, they watch economic data. They track inflation trends. They follow central bank statements, because understanding these signals can give traders an edge in the market. Inflation is more than just rising prices. It influences interest rates, economic growth, investment flows, and the value of currencies, which is why inflation data is one of the most important indicators in the entire Forex market. So the next time you see CPI or inflation data on the economic calendar, don't ignore it, because behind that single number could be the move that drives the entire Forex market.
Hey, if you found this video helpful, don't forget to smash that like button, share it with your friends, and subscribe for more insights on trading, money, and the economy. Hit the bell so you never miss an update, and let me know in the comments what topic you want me to break down next. Thanks for watching, and I'll see you in the next video.